This is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. It's great to have your company. I'm Ross Greenwood. Coming up on the program today, as Donald Trump starts cutting deals with a host of countries for trade and tariffs, there's one vital commodity for Australia where a massive project hangs in the balance. It's copper, a key element for any modern economy. And right now, South Australia is holding its breath as it awaits BHP's decision on the expansion of Olympic Dam. The South Australian Premier Peter Malinauskas is our special guest today.
So Olympic Dam has a major opportunity before it, provided we can make sure that the economics stack up.
The tariffs will almost certainly change the way the world works and the way that business invests. So we speak with one of the world's most acknowledged economists and authors, Paul Sheard, the former chief economist of Standard & Poor's.
Well, I think it's a little bit like, the old story of someone who's banging their head against the wall, and then when they stop, they feel much better.
And this week, Australia's near-record stock market gets its ultimate test as most companies start reporting their annual profits for the June 30 year. So we brought together two of Australia's leading funds managers, Investors Mutual's Anton Tagliaferro and 10 Capital's June Bay Liu, to get their take on whether the profits justify the share prices.
I do think next 12 months, these companies will be the leader in terms of returns, for our markets when we compare to the offshore.
So all that and plenty more coming up on today's program. But look, let's start with copper, which is not only essential for human life, but also for any modern economy. It doesn't matter if you think wind turbines, electrical vehicle batteries, data centres, advanced manufacturing, defence or aerospace. Copper is in massive demand around the world. The biggest producers of copper are Chile, the Congo, Peru and China. Australia also is a very big producer, as we'll hear shortly. The US and China, with their giant tech sectors, are the biggest consumers. But Donald Trump wants more copper produced in America, and he's willing to use a 50% tariff to achieve it.
Ones we did steel, as you know, they're 50%. We did aluminum, 50%. Lumber just came out.
Why don't you announce copper?
And we did cars. And now today we're doing copper.
Copper and lumber. What would that tariff be on? The sectional tariff?
I believe the tariff on copper, we're going to make it 50%.
50%.
So Edward Boyd looks at Australia's position in the global copper market and the market dynamics that keep pushing the copper price higher.
Australia holds the world's third largest reserves of copper, but when it comes to producing the non-ferrous metal, we rank 8th.
So we got Chile with 190 million tonnes, Peru with 120 million tonnes. We've got 100 million tonnes of copper at $10,000 a tonne. It doesn't take much to work out how positive that is for our society.
BHP owns the world's largest copper mine in Chile, called Escondida. It's an open-cut operation where the ore body is close to the surface and easy to access. But here in Australia, most copper is found 1 to 2 kilometres underground, and it's difficult to extract. The ore needs to be crushed and then brought to the surface, crushed again, processed, and then put through smelting and refining.
It's a very long and complicated process, and it uses a lot of energy and a lot of water and all the rest. It's not an easy process because the typical grade of copper is 0.4%. So you have to lift 250 to 300 tonnes of rock to the surface to get 1 tonne of copper.
But the payoff from producing copper is massive. Prices are close to record highs at about $10,000 a tonne on the London Metals Exchange. And as copper gets harder to find, the major mining companies are trying to increase production.
BHP are very big in copper, as you outlined, through Escondida and some of their other mines. And they're acutely aware of the supply side challenges in trying to grow their business. And that is true not just of them, but entirely of everyone in the industry. So they're all facing grade decline, greater competition for scarce resources such as water in Chile, and that just makes it harder to grow copper production that the world's going to need. So BHP is pivoting to copper, but so is just about every diversified miner on Earth.
Copper was the first metal used by humans about 11,000 years ago. It's resistant to corrosion and can be easily mixed with other metals to form alloys like brass and bronze. It's also highly conductive and crucial for electrification. Most copper's turned into cables, tubes and pipes, which means it can be found at every building site around the world.
Copper is one of the more abundant minerals on Earth. In fact, it's used in just about everything that we have. The average Aussie household has 90 kilos of copper. But there's a new demand for copper from things like artificial intelligence and computer chips that's driving the price of the resource to record levels.
According to BHP, copper demand lifted at a compound annual growth rate of about 1.9% over the 15 years to 2021. But this is expected to pick up to 2.6% by 2035. And that's due to global GDP growth, the energy transition and the construction of data centres.
The global demand for copper is enormous, absolutely. And you know, the move to building up the data centres to support AI is fantastic. The move to electrification of the transport fleets, you know, industrially or in commercially or residentially, is phenomenal. The demand for communications is going up. So yes, copper, we see it really, really strong.
Earlier this month, US President Donald Trump said his administration would place 50% tariffs on copper imports from the 1st of August. This snap announcement's caused a disconnect in copper prices between the London Metals Exchange and the Chicago Mercantile Exchange. CME prices are now at record highs, about 30% ahead of the LME.
The general tariffs that he's placed on the market, that has caused a lot of copper metal to go into the United States. There's also the threat of copper-specific tariffs on top of that, which are causing, again, people to move copper metal to the US. What that, in principle, has done, I think, has buoyed the short-term price of copper. You've got an unusual situation where the US copper price is trading at a reasonable margin to the LME price. Normally, it's a very tight arbitrage-driven range between the two.
Copper is nicknamed Dr. Copper, meaning when prices accelerate, GDP growth lifts as well. And many mining companies believe this is still the case in 2025.
It's a very good time to be in copper. I mean, you'll see lots of the talk on the global stage, but price is certainly appreciating, and it's just driven by the fundamentals, so supply, demand. So we can see all the normal source of demand for copper, so Dr. Copper as it's often called, tracking GDP, but then you've got electrification, then you've got data centres, and then on the supply side, supply is increasingly constrained, so mines are getting harder to find, lower grade, harder to mine. So all that means upwards pressure on prices.
29Metals is a mid-cap precious metals and mining company with production and exploration assets in Australia and Chile. Its CEO believes the tariffs are shining a light on Australia's copper assets.
Tariffs themselves don't, they don't create any more demand. In fact, potentially reduce that, and they don't create any more supply, certainly in the short term. So it's more the volatility, but it has certainly heightened people's awareness of maybe just how undervalued some of the copper market is in Australia, which is good for us.
Aurelia Metals is an ASX-listed mining and exploration company with a large land holding around the western New South Wales town of Cobar. It produces a range of base metals including copper, gold, zinc and lead.
There's definitely a lack of supply for copper in the future, and so there's an increasing demand for copper in the future. So I think we're in a position where we're going to really be building our businesses at a time in copper when copper demand can only increase.
This month, Aurelia began expanding its Great Cobar project, which will require a capital investment of about $92 million.
It's a copper-gold deposit, which will basically be developing over the next 2 years. And by 2028, we'll actually be a copper-dominant sort of business, and base metals a dominant business from 2028, where we're using the gold resource of today, and the great revenues are coming from gold from our current Peak South mine to fund our future.
John Fennell is the head of the International Copper Association Australia. He says the major problem with Australia is its regulations and red tape, where it can take up to 20 years for a copper mine to be developed.
I mean, everybody has very positive ambitions and objectives. I think simplifying the regulations and being clear between what the Commonwealth is intending to do and what the states are doing, and getting some synchronicity between them, so that the investors in copper mines know that it's the process may take them 2 or 3 years, not 8 or 10 years, to get these basic approvals. And because it's, it frightens off capital. And capital will find an easy place to make money. And if it's not easy, it'll disappear on you. And that's sort of been what's happening.
BHP's Olympic Dam mine in South Australia is the 4th largest copper deposit in the world. In 2027, it will make a final investment decision on whether it will expand its smelter and refinery, which will roughly double its copper output to 650,000 tonnes by the mid-2030s.
Well, Australia, and more specifically South Australia, is home to the 4th largest copper deposit in the world, Olympic Dam, owned by BHP. It's also one of the biggest gold, silver and uranium deposits on the planet. Olympic Dam, which was discovered by Western Mining, has been producing since 1988. BHP took over Western Mining. But BHP knows there's another leg of growth to Olympic Dam, which includes expanding its smelter and refinery with a likely cost of many billions of dollars. But the final decision on whether that will go ahead isn't due until the first half of 2027. And the question now is whether Donald Trump's tariffs will cruel the economics of that massive expansion. One person who has plenty riding on BHP's decision is the South Australian Premier, Peter Malinauskas, and I spoke with him a little earlier.
Well, I think we've got to be honest about the fact, Ross, that whenever we see a tariff decision of the likes that President Trump has made, it's not welcome. I think it disrupts the flow of capital in a way that isn't necessarily helpful. Having said all that, we don't believe it represents a major material risk to this expansion, simply because BHP, in conjunction with my government, are actively exploring it on the basis of massive growth in demand of copper globally, but also uranium as the world continues to produce more nuclear power, which is an important resource as well at Olympic Dam. 70% is the figure that we expect copper demand to grow by over the course of the next 25 years. And even if all of the copper mining projects globally were to reach FID, we still don't get to that number. So Olympic Dam has a major opportunity before it, provided we can make sure that the economics stack up, and certainly my government's working closely with BHP in that regard.
So your government has already had to plan via your state prosperity project to spend money to encourage this investment, which includes obviously water and electricity infrastructure. But you would be highly conscious that capital is mobile. If things change, it can move away very quickly.
Yeah, of course. And we acknowledge there's always a risk to that, which is why we've got to approach this particular investment and project in an iterative way. We've got to do it step by step, methodically, in conjunction with BHP, seeing them as a partner more than anything else, to make sure that we're working in a way that is transparent between us. But we acknowledge as a government that this is a big opportunity for our state. If we're serious about growing the state in terms of generating new wealth and new industry, we've got to play a role. We can't take a hands-off attitude. And we're very conscious of the fact that the provision of water to Olympic Dam is absolutely critical to unlock this opportunity. And that's where we see us playing a role, particularly where there is a potential shared use for this critical piece of infrastructure, because there might be other opportunities that emerge as a result of a desal plant and a pipeline of the nature that we're working on. But all of these judgments, we acknowledge, are occurring in an exceptionally complex global environment. But the flip side of that, Ross, is for those that get it right, with a genuine sense of partnership between government and capital, in this case BHP, then there is a wealth of opportunity for us. And that's what we're utterly committed to actively exploring. And we've already achieved a lot over the last 12 to 18 months, and we want to keep that work going.
Are you conscious of the speed with which your government has to make decisions to approve projects? Because that can sometimes be the key to their success or failure. We hear of some projects, for example, taking nearly 2 decades to get approval in Australia.
Yeah, and that is always a source of frustration. To the extent that the approvals are reliant upon state government, and there are a lot of them that are, we have established an expedited process. Recently, we passed legislation through our state parliament to do exactly that, with the establishment of a coordinator general for major projects such as this. That's a legislative reform that we've developed in conjunction with industry to make sure we've got it right. Look, we're working really hard in South Australia, Ross, not just in respect of the speed of approvals, but make sure that our taxing regime is low, and it is the lowest in the country. The Business Council of Australia have listed South Australia as the #1 jurisdiction in the nation to do business, and we've worked hard to achieve that through a range of reforms around tax, around the regulatory environment, but also about wanting to make sure that our outside sources of capital see us as a stable, reliable jurisdiction to partner with, because that has a particular value in a world where instability is increasingly the flavour of the month.
So what you're talking about there is a competition for capital, the competition for projects. So just explain how you see that landscape inside Australia, but also from the outside looking in when foreign capital is actually looking for projects here in Australia.
Well, look, in a world that is turning upside down around us, and critical minerals, and copper is probably the most critical of critical minerals, are in demand, Australia looks like a pretty safe place to invest. And I think that's particularly true in South Australia if we can make sure that the return on that capital is maximised by reducing unnecessary costs that serve no purpose. Also, if government is serious about wanting to invest in infrastructure, we've got to have the wherewithal, Ross, to not just invest in infrastructure that is a cost to government in the terms of service delivery, but actually use our balance sheet to invest in exclusively economic infrastructure. Let me be honest, Ross, no one comes to me and knocks on my door and says, "Hey, Premier, can you please build us a desal plant and a 600-kilometre pipeline to move water to somewhere where no one's going to drink it?" They're more interested in roads and schools and hospitals, and I get that. But governments have to have the capacity to invest in economic infrastructure to generate new wealth, so that in turn we might have some royalties coming our way into the future that allows us to invest in schools and hospitals. We've got to have the wherewithal to do both. And that's something that we've got a political responsibility to make that argument and then deliver these projects successfully.
Well, you mentioned there the Business Council of Australia has named South Australia for 2 years running as the best state to do business in Australia. Now, that has a lot to do with not just the speed of decision making, but also the taxes you impose on business. I sort of see right now that there's almost a thrust not to reduce taxes in Australia because obviously there's social needs in this country as well. What's your own sense of trying to balance up, trying to get your economy going to grow it faster versus the need to obviously generate revenue for the greater social good?
Yeah, well, of course, governments have to be fiscally prudent, and we're running budget surpluses here in South Australia. In fact, we've just recently delivered our 4th budget, and it contains our 4th surplus. But maintaining an eye on revenues in the context of your expenses, but without having to change the revenue base, and that provides a shock to capital, is the key. I think transparency and being honest about what our responsibilities are in terms of service delivery and the costs of where we see that going into the future is important, not just to the business community, but to the electorate as well. But what we've been able to do is grow our state's economy at a pace that we're not really accustomed to in the past, and that growth in the size of the economy has negated our need to actually make changes to the tax base. So that's a pattern that we would love to maintain into the future. But of course, that's always a challenge, and we have to keep an eye on the costs of the government in order to be able to have the confidence to be able to do that.
Well, the federal economy, the national economy, is barely growing, has barely got a pulse at the moment, 0.2% in the last quarter. My sense is the economic roundtable to see what can be done to try and improve that. But I just wonder whether the discussion should be as much about Australia's competitiveness, which you and I are talking about, as it is about productivity. The two surely have to go hand in hand, but competitiveness, state competitiveness, global competitiveness, they're the keys to trying to get the economy moving faster.
Yeah, competitiveness is absolutely, of course, important and as much as productivity. And what we have to do, in my view, as a country is work out where we want to be able to compete. On what basis can we outcompete our competitor jurisdictions for capital? And I think that invites Australia increasingly investing in becoming a smarter country. Our R&D base in Australia is very low in comparison to other OECD countries. Less than almost every other country, in fact, we invest in R&D. And that, of course, is at the expense of productivity and competitiveness. In order to move up the value chain and become increasingly competitive, we need to be deploying technologies and intellectual property that we generate here in Australia that is able to see us outcompete our competitors. So that is something that I hope is top of mind in the productivity roundtable that I think to Jim Chalmers' credit he's convened with the Prime Minister in coming weeks. Investment in R&D and seeing universities as a potential source for microeconomic reform in this country, rather than just a sort of educator of students. We've got to see them as a potential powerhouse for economic advancement.
OK, on the subject of competitiveness, while we're there, just a final one for you. The South Australian and federal governments this week committed to a combined $275 million to keep the Whyalla Steelworks running. That's part of the $2.4 billion rescue plan. My question to you is, can the Whyalla Steelworks ever be truly competitive on a global scale?
Well, that's the challenge before us, and I don't think it's going to be an easy task, Ross. Let me be candid about that, and I've said that ever since we intervened to change the ownership of the steelworks. But the opportunity is before us by virtue of where the steelworks is located. It's located adjacent to a port and adjacent to an exceptionally high quality magnetite resource, which is an iron. We have, when we think of iron ore, there's hematite and magnetite. Magnetite lends itself to a decarbonised version of steel making, which may make it, or even green iron, which of course is an export industry that a number of steel producing countries would be very interested in. We see that decarbonisation path necessarily requiring an increase in supply of natural gas at an economic price. And in that regard, of course, Australia does have significant gas reserves, and my government is very much an advocate of using gas as a means to decarbonise what is otherwise a very carbon intensive activity in respect to steel production. So those things, with the gas opportunity in South Australia combined with the magnetite mine and the fact that the steelworks exist adjacent to those and a port, I think is a unique opportunity if we can get the right owner of the steelworks. And this is the challenge, Ross. We don't just want a new owner of the steelworks. We want the right new owner who has the balance sheet and the wherewithal to bring all those component parts together and do something globally unique. If it is able to do that, we can have a transformation that may be globally competitive. But there's a lot that needs to happen between now and then, and I'm, for one, very grateful that the federal government's put the lion's share of that money on the table to give it a chance.
I'll tell you what, Peter Malinauskas, it's always a big picture talk when we ever have a conversation. I really appreciate it. Many thanks for your time today.
Thanks, Ross. I appreciate it. Cheers.
Coming up after the break, we look at the likely impact on markets and the economy from Donald Trump's tariffs. That's when we come back. It's great to have your company here on Business Weekend. Well, this week, Donald Trump accelerated the trade deals that he's doing with various countries in advance of his August 1 deadline, when he'll announce the tariff rates on goods across the globe. Coincidentally, Australia decided to formally lift the ban on US beef imports, even though technically they'd previously been lifted for cattle that could be proven to have been born and raised in the United States. Now, there's little doubt financial markets around the world will react to the new trade environment. Someone who's been thinking about all this, Kerry Craig, the global market strategist with JP Morgan Asset Management, who joins me now. Kerry, always great to chat to you. I just want to go to this because clearly the tariffs and the trade not only skews market. We saw that in Japan this week with automakers sort of taking off, going through the roof. But then even in Australia, the potential of new tariffs on certain goods could skew the way in which markets behave into the future.
Absolutely. I think what you've seen with the trade frameworks that have been announced so far with some of the countries around the Asian market really a relief to the markets, because they are showing that the tariffs aren't going to be as high as what were put through in those letters to these countries. They're not as high as what was announced on that reciprocal tariff basis. And so the market is showing some relief, particularly when it comes to things like autos in Japan. However, it does really solidify the fact that there is a new baseline for the tariffs that the US wants to impose on its trading partners. And it does look like that that is going to be closer to 15% rather than 10%. And so for Australia, we have a 10% tariff at the moment. We're largely flying under the radar when it comes to a lot of these tariffs, given we have a trade surplus with the US rather than a trade deficit. And so I think for us, it does mean that we aren't going to feel the full impact directly from the tariff effect from the US, but perhaps through some of our trading partners. And I think it really does come back to the fact that, we're a small, open economy. We're reliant on Asia and particularly China for that growth. And as long as that growth is coming through on those trading partners, we should continue to see the Australian market expand in that environment as it thinks about where it can send its exports and, again, where we might receive imports from that would normally go to the US. And so there could be some benefits for consumers here, particularly if we see cheaper products come into Australia.
So that is almost an argument or a justification for the record share prices that Australia has set over the past period of time. And indeed, what you're saying is, as a net beneficiary of these trade wars, Australia could come out in front. It's got places it can send its goods if it doesn't want to send them to America. Also, it might get cheaper goods coming into Australia, which helps to quell inflation.
Well, to a degree, I think that the tariffs and the trade changes we've seen around the world, they're a tax on most people. So they're, at a net, going to be a drag on the global economy, and they'll create probably a bit more inflation in the US. For Australia, though, we're not getting the worst deal of every country out there, and I think that's probably the main focus. What's driving the markets in Australia, though, isn't necessarily that view around international trade and growth outside the US. It has been one where we've seen, some of the domestic and the banks do very well over the first part of this year, and thinking more now around potentially a rotation within the equity market towards maybe more export-orientated parts of the market, the material sector, the miners, who may see some benefit from some of these global growth fears that are receding at the moment.
Okay, so you've also spent some time thinking about currencies and what might change with currencies. You've seen a decrease in the US dollar. You've seen the Australian dollar this week out towards 66 US cents, the highest it's been for some time. The question is whether that also starts to skew the trade a little bit and whether that is ultimately what Donald Trump wants, a lower US dollar.
Well, I think that the US dollar falling was probably an unintended consequence, and perhaps what the US wanted in terms of making its exports look more competitive, but I don't think it was the main objective. Obviously, it wanted to elicit higher revenues from tariffs from its trading partners to try and address some of the deficit and some of the spending plans and tax cuts they're putting through. But I think the fall in the US dollar has more been a reflection of global growth looking more balanced between the US and the rest of the world. For a long time, the US was the fastest growing large developed market out there, and that meant that a lot of money flowed into that country. And then also some of the concerns around the fiscal position in the US, as well as thinking about some of the institutional integrity in the US, given some of the concerns around the US Federal Reserve. But those capital flows out of US assets, which were very widely held by investors outside the US into places like Japan, Europe, emerging markets, have all been a headwind to the dollar performance. And the US dollar is then down 10% year to date. And I think on the basis of seeing money flow towards other markets, thinking about the structural challenges with the US dollar in terms of the size of the deficit, as well as the size of the current account deficit, they would all suggest the US dollar has further to fall. And that will mean that on a cross basis, the Aussie dollar should see a little bit more appreciation, in our view, heading back up towards close to 68, 69% over the course of this year.
I'll tell you, it's always great to have you in the program, Kerry. Kerry Craig is a global market strategist, the chief global market strategist for the Asia Pacific with JP Morgan Asset Management. Many thanks.
Thank you.
Well, let's keep examining the impact of these tariffs and the way that governments and central banks will behave in the future with Paul Sheard, the former chief economist at Standard & Poor's and formerly chief economist with Lehman Brothers and Nomura. He's also the author of the Wall Street Journal's bestseller, The Power of Money. I find him in Tokyo, which is appropriate given the 15% tariff deal that Donald Trump seems to have done with Japan this week. So in turn, that caused Japanese auto stocks like Toyota, Nissan, Mitsubishi and Honda all to take off on the stock market this week. Paul Sheard, always thanks for your time. It seems as though many people are saying that maybe Japan's got the better end of this deal, despite the fact that on the surface, a 15% tariff was not quite as good as what they had before.
Indeed, Ross. Well, I think it's a little bit like, the old story of someone who's banging their head against the wall, and then when they stop, they feel much better. Donald Trump has been playing this kind of, Trumpian clever game of, putting out these very, very large numbers on reciprocal tariffs and then saying, okay, you have 90 days to try to bargain them down. And so he's been using that as leverage. So certainly 15% is better than 25%. And so I think Japan is sort of breathing a bit of a collective sigh of relief. But it still is, of course, an increase on what was in place before Trump came along.
So then take me to where central banks sort of end up sitting with all of this, because again, you can see the conflict between the US administration, Donald Trump, and his own Federal Reserve, and in turn, any sort of reluctance to try and cut interest rates from the US Federal Reserve, of course, then plays into global markets as well.
Exactly, Ross. And of course, the situation between Trump and Jay Powell, between the administration and the Federal Reserve in the US is quite fascinating and complex. I don't have a problem per se with the administration expressing its view to the Fed, but of course, it's up to the Fed to make the call. That's what an independent central bank is all about. And of course, we have a situation in the US where inflation, the post-COVID inflation, has come right down, but it's still stubbornly a few percentage points, couple or a few percentage points above where the Fed would like it to be. So the work has not been done yet. Now, central banks are forward-looking. So as the Fed looks forward, of course, it now has all of this tariff, these reciprocal tariffs to deal with. And, the administration, the economists in the administration are kind of taking this very rosy kind of view that, the cost of the tariffs will not fall on the US consumer. Therefore, the Fed doesn't have to worry about the price impacts. But of course, that's rather dubious economics. And the higher the tariffs that are applied country by country to US major trading partners, the more there would be a one-off effect, or at least upward price pressure domestically. That doesn't mean that it would be continuous inflation. That's a different matter, but at least upward price pressure in the short term. So from the Fed's point of view, it's saying, it's a little bit too early with inflation above target, more in price pressures in the pipeline to be cutting interest rates. And of course, Donald Trump doesn't like that very much. But the irony is that one of the main factors behind the Fed having to slow down a little bit at this stage is the very tariff policy that the Trump administration is putting in place.
Okay, then go to Donald Trump, because Donald Trump says the tariffs are the way that America ultimately pays for its increased spending. He's got his spending bill through the House, so now it's got to be paid for. He says that comes through tariffs. The big question is whether that is enough to obviate what has been a mounting debt for the United States, which at some stage has to have an effect of dampening economic growth in the US.
Well, the US is, of course, the biggest and most powerful economy in the world, the biggest and most powerful military, and has the kind of reserve currency of the dollar. So I don't think, Ross, the US is going to run out of money, so to speak. The debt situation certainly has deteriorated from the viewpoint of, debt to GDP ratio. But the US can, can spend a lot of money and issue a lot of debt. The issue, though, rather, is what effect that will have on inflation. And so that's where tax revenue comes in, because tax revenue really, of course, is withdrawing purchasing power from the economy. It acts a little bit like a tightening of monetary policy. So I think that it's not so much, where is the US going to get the money to pay for the, increased budget or the budget spending and therefore increasing deficits, so much as what is the appropriate monetary and fiscal policy mix that the US will need to keep inflation under control.
And the punt that Donald Trump takes is by cutting taxes in America, by increasing these tariffs, he drives investment into the United States and hopefully creates stronger economic growth. So his answer to the debt and deficits appears to be to try and accelerate America's growth.
Yes, exactly. I mean, obviously, Donald Trump is not your classic sort of economics student, but he does seem to have a couple of sort of economic beliefs in his thought system. One of them is he doesn't like trade deficits. And the other one is he wants more manufacturing jobs in the country. And so, he is engaged in a pretty ambitious industrial policy, if you like, using trade policy. And, the old idea of the WTO, most favored nation treatment, that kind of idea is out the window now. And so using a very strong bargaining position, he's trying to go through trading partner by trading partner and say, what are you going to do for me? What are you going to invest in my country? How are you going to open your market so that we can export more to you? So it's a very sort of industrial policy managed trade, kind of throwback to earlier periods, and in fact a throwback to perhaps some of the thinking that was predominant in Japan in the 1960s and 70s and 80s. But he's pushing a bit of a big boulder up a hill here, because the manufacturing sector in the US, is now about 8% of employment. He might be able to push that up, a tick or two, and maybe even half a percentage point over time. But it's not really going to be a game changer, I don't think, in terms of the whole $30 trillion US economy, which is very high-tech orientated, very service sector orientated, very consumption orientated. I mean, you can look at the big trade imbalance, trade deficit in the US as a trade issue, but you could also look at it on the other side of the ledger as reflecting insufficient domestic savings relative to investment and too large a budget deficit, which is, of course, the issue you were focusing on before. So the deficit is tied up indirectly through the operation of a complex economy with the trade deficit and the so-called current account deficit.
Paul Sheard, many thanks for your time. I always learn something when we speak to you, and I look forward to doing it again shortly.
Always a pleasure, Ross. Thanks very much.
When we come back, we turn to the Australian stock market with two of our favourite fund managers, Anton Tagliaferro and Junbei Liu, as most local companies in August are set to report their full-year earnings. It is great to have your company here on Business Weekend. Well, this week we hit the 1st of August, and that's not just the deadline for Donald Trump to announce his global tariffs, but it's also the beginning for most of Australia's companies to report their full-year earnings results. And given that our stock market's been at or close to record highs for most of this year, it's also a test for most of these companies and their share prices. So I bring in two of Australia's most experienced portfolio managers, Anton Tagliaferro, the founder of Investors Mutual, and also Junbei Liu, the founder of the long-short funds management company 10Cap. Many thanks for your time. Junbei, I'm going to start with you.
Sure.
This is a big test for Australia's record share market. So now, broadly, can the profits of these companies keep up with their share prices?
Look, absolutely, I think they can. And what's importantly, though, is we think the outlook statement will be far more positive than what they deliver for the last 12 months.
But how can that be, given the fact that Australia's economy is barely bumping along beyond recessionary levels? It's not even growing at 1% per annum on an annualised basis. How can company profits justify record share prices?
No, absolutely, because remember, share market, we always look forward 12 months. So investors today trying to buy what earnings look like in 12-month time. So, in 12 months, certainly Australia's economic activity should pick up. We already had 2 rate cuts. Things started improving a little bit, but not yet. And then we got another 3 priced in for the next 12 months. So that should definitely kick along our economy. And put that aside, we should also have China start doing a little bit better. Not so much better, but a little bit better. Less bad, if you like. And so that should continue to see the commodity prices to be underpinned. So our resources company might be just doing a little bit better than expected. And there's a lot of dividend these resources company pay back into the investors in the Australian economy.
Okay, Anton, the big question here is whether Australia's stock market is priced for perfection. Whether you believe that these profits can justify the record share market that we've been at for pretty much most of this year now.
I think it's a tough one, Ross. I don't think it's as straightforward as we were saying. I think, again, if you look sector by sector, obviously the resource sector has had a tough 12 months. The iron ore price has been weaker, coal, etc. The gold price, obviously, the exception. The oil price come off, right? So resource sector won't come out with great results, but that's sort of expected. And as we were saying, it'll be really the forward outlook, which is a bit of a bet on global economic activity in China, right? When you look at the industrials, as you're saying, it's a pretty, subdued sort of economic environment, particularly in Australia. But it's a benign environment, right, where we have interest rates are low, inflation seems to be under control, right? So there don't seem to be many clouds on the horizon. Having said that, some of the valuations of these stocks, we've talked about CBA before.
Well, I was going to say,
talked about Wesfarmers.
The banks generally.
There are certain, even Telstra now close to $5 again, right? It's hard even if the outlook improves a bit, it's hard to see, famous last words, but huge upside from these levels. Look, the market's got this momentum behind it. We've gone almost from the flip side from April, where we had a meltdown. We've almost got a melt up now, where you've got this sort of, surge of buying coming into different sectors. The one thing I will say, though, is that the market rally has broadened a bit as the banks are coming off. There's a bit of a rotation back into resources on the hope that, resource prices will be better. Some of the laggards like Horizon, etc., are doing a bit better. So there is the market rally has sort of broadened, which is probably not a bad thing.
Yeah. So, Jimbe, I mentioned earlier, of course, as we always do, that you are a long-short fund. During this period, have you gone short the banks because they were priced for perfection, and especially the Commonwealth Bank?
Look, absolutely. I do think the banks looks very expensive, and, this is your opportunity. Really just use that to start buying something else. When we think about what's going to drive return for the next 12 months in the share market, it's probably not your Commonwealth Bank. It's going to be the companies that's cheaper. That's earnings going to be linked to our economy, because we just said things might get a little bit better. So you will buy the company that will give you next leg of growth, which is the cyclicals. Some of the retailers may be really good buy because some of them maybe had a bit of a tough patch, and next 12 months things will look better. And remember, for an economically sensitive company or sector like retailers, for example, analysts always underestimate how much operating leverage there is on the upside or the downside. So, we do think the analysts are a little bit under on those cyclical sectors, and they will be the ones that kind of will drive.
So which stocks would you have in your portfolio if you're looking to have those genuine cyclical stocks sitting in there at the moment, ready to go?
Absolutely. So the retail companies, so your JB Hi-Fi, I know it's done really well, but you should really pay attention to the leverage in the next 12 months. I still think analysts will be undercooking it. And I think the furniture companies are interesting, because the housing turnover hasn't got a pick up yet, but we see the housing prices, every auction is being very, very strong. So you want to buy the housing-linked companies. So, whether it's your realestate.com or it's your, your
Nick Scali is another one.
Nick Scali, your Harvey Norman, some of those housing related, and also some of the retirement living sort of businesses, because they are very much linked to the housing market as well, because if you get at a high prices for your house, and then you move into the retirement living and the like. So you've got your engineer, you've got the recently listed Gem Life, that's very interesting. Stockland's been doing well, but I think will continue to do very well. So all these businesses will do well in terms of linked, and also the interest rate sensitive sector like the property trust, I think they will continue to do quite well because rates are cheaper.
All right, so you've always been renowned as a value investor looking for stocks that are low as compared with their potential growth in the future. Is there anything cheap on the Australian market right now?
Yeah, there are, particularly I think at the smaller end, like stocks like GWA, which we've been buying on a P of 13. Not exciting,
But the small end, the small cap market, it's been almost bereft of any growth for the past 2 or 3 years.
Well, again, Ross, you're talking as a whole, right?
Yes.
And that's obviously been influenced by the resource names and some, but actually some of the industrials, some of the speculative type small caps. I mean, Hyperion X, I don't know if these are stocks. Quario, whichever, which we own, we've dabbled in some of these things. They don't make much money or whatever, and there's a bit of froth and bubble in some of these things. But also we're finding, in some of the good, solid, less exciting industrials, things like GWA, Southern Cross, which is radio and podcasting, they're extremely cheap. And given the cycle may improve, should improve if rates come down, when you're buying them on P's of less than 13 or whatever they are, and good yields, they look quite good. At the moment they're a bit ignored, they're not sort of very not much in favour, but there is value there, so we're buying those stocks that are solid, they've been around a long time, they've got a good recurring earnings stream, and they look cheap.
So we've talked a lot about tariffs and Trump and all that sort of stuff. There's a whole lot of Australian companies now that have got big operations in the United States. Doesn't matter whether we go to BlueScope, Brickworks have got plants there, you've got James Hardie, you've got ResMed, you've got Cochlear, you've got potentially a little bit of CSL that could be affected by tariffs. Tell me this, is there a theme there whereby companies that are manufacturing in the United States might actually get a bigger bang for their buck than those who are trying to manufacture here in Australia?
To some extent, but I think the tariff thing's being discounted to a great extent because it does change. The story does change very rapidly. And, what Trump says and what Trump ends up doing, I think the markets have learned can be two very different things. I mean, he threatens all sorts of things, but the end result always seems to be some sort of watered down version. So I don't think the market's too concerned about that. I think at the end of the day, it's all about the US getting their trade deficit down, which they're doing through some of the tariff deals, through growing their LNG capacity and growing their exports, so that's the main game. I don't think tariffs is figuring in, but we'll see in the reporting season. Yeah. That may be the area of surprise. Where companies come out and give their estimate of the impact of these potential tariffs.
Because I wonder about this, because given the fact we've got this productivity summit roundtable, the economic roundtable that the Prime Minister's got coming up, there's going to be a lot of attention paid to Australia's competitiveness, about whether we can compete with the world here, whether capital moves overseas. I just wonder whether this is a bigger theme for investors to consider into the future, whether it's something that you consider when you're looking for investment opportunities.
Oh, look, absolutely. So, with the tariff scare for the market, the investors started paying a lot of attention about homegrown businesses and businesses that kind of sort of invest within and then less exposure to what's happening globally because of the uncertainty. We just touched on these companies, for example, Breville and the Ansell, they just couldn't even give guidance because they don't know what it looks like. It will cost so much more for them to diversify their cost base. And, and then we all know it takes about 10 years to really have an efficient supply chain. So now there's definitely more attention paid to domestically focused businesses and investment within domestic. I do think next 12 months, these companies will be the leader in terms of returns, for our markets when we compare to the offshore.
And so broadly, tell me, once we get out of this reporting season, we see this. What do you sense in terms of the market? Is it going to be higher, lower, flatter? What do you sense over
Look,
that?
It's going to be higher, the market. I think market definitely heading higher towards the end of the year.
And what about you? What do you think?
Honestly, I give up trying to predict the market, Ross. It's so, we've seen this year how unpredictable it is. But look, at the moment, it's well supported. People seem to be buying the dip. As I said, the economic outlook is pretty benign, It looks like inflation is under control. Interest rates are sort of coming down in Europe and Australia, but sometimes possibly in the US. So that's kind of supporting the market. The other thing to watch is the US money supply, the M2, which was sort of coming off. They were pulling back on the quant easing. They were quant tightening, but the easings, they're pumping and printing money again, which I think is also sort of pushing up markets and things like Bitcoin and stuff. So.
I'll tell you what, Anton Teguliferro, always good to chat to you with June Bay-Liu. I reckon you're just such a good pair together and so much experience as well. So thank you so much for your time today.
Thanks, Ross.
Thank you very much.
Well, that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course you can keep up to date with all the latest business news with our daily program, Business Now, 4:30 Eastern Time and via our website, skynews.com.au. Thanks for your company. I'm Ross Greenwood. We'll see you next week.